All right. Well, welcome everybody to our podcast. I'm joined by TJ Troutner, managing partner of Equius Partners and a longtime friend.
Good to be with you.
Yeah, TJ.
Thanks for having me along.
So I'm Lachlan MacLean, Wealth Advisor here at Equius. And what better time to kick off a new podcast than with the new year? So here we are, 2021.
Yeah. New Year's resolution. Get
Yep.
your financial house in order.
Exactly. So that's what we're going to be talking about today. We're going to take this opportunity to talk about the things people should be considering with their finances and investments at the start of the new year to set themselves up for success in 2021.
Yeah. And we're coming off of a year, 2020, that gives us a lot of lessons that we can learn. And it's no better time than now, really, to reflect back on the year and think about how we handled the market gyrations. It was, I remember earlier in the year, and I'm fairly certain that this is one of the most volatile years on record. And that's it's tough for people, not to mention all of the other things that we had to deal with from a health perspective, businesses having to shut down. So it's, I think in particular, 2021 is a great year to sit down and really think about how you get yourself organized, how you get yourself on the right track, put a plan together so that if we go through another 2020, which, I think inevitably we're going to as human beings and investors. So it's great to sit back and just reflect on that and learn some lessons and build our build better practices for ourselves from a financial perspective.
Yeah, 2020 was a doozy, that's for sure. And I think this is a great opportunity because when we think about New Year's resolutions, most people think, what sort of diet New Year's resolutions, health, career aspirations and goals. And, as often the case when we work with people and put together financial plans, what we often find is this area of their lives can be overlooked. Or they set something up early, like let's say a 401k plan. They set up their investments, they set up their plan and everything, and then they don't look at it for a while. Don't realize that changes, these things should be reviewed and changes may be necessary,
right?
But it's a set and forget it. So let's use this opportunity, start of a new year, resolutions, all that, to get a good glimpse of where we came from and what we do to, again, set ourselves up for success in 2021. And I think, we'll start off a little rudimentary, but worth mentioning and discussing for a little while is the first step is probably putting a budget together.
Yeah.
It's a simple step. It's a good first step, but that'll give us a good sense for where we are today and where the adjustments need to happen.
Yeah. I mean, really what you want to have in place in your financial life is a plan, and you want it to really touch all aspects of your financial life. And you can think of a budget as really the foundation of that, right?
Yep.
And again, I'm going to belabor this point throughout the podcast here, but 2020 definitely made people sit back and think about what they were spending, right? And that's really the goal of a budget, should be sitting down, reflecting on the expenses you have, cutting the fat, making sure that you're not spending money on things you shouldn't be spending money on, and getting a really good handle on what you're saving, right? And that's a very important thing. And we're gonna talk about having emergency funds and having retirement accounts and investments. But 2020 gave us a concentrated view of, there's a lot of folks out there who lost their jobs. People got furloughed. People, had pay cuts. We work with a ton of entrepreneurs, and not only did they have to take care of their family because of a loss of income, but they also had to potentially, put money into back into their business to keep the lights on and keep people on payroll.
And medical expenses, right?
Yeah.
So there's a lot of things that you can prepare for, whether they're tangible in the moment or not. That's the importance of having a budget. What also comes from that is, which we'll talk about more, is when you have a good sense for what you need to spend and what is kind of just discretionary, you have a sense for how much you can put away each year, not only in savings, but how much you can direct towards investments to make that money grow for you. And that's where we're going to spend a lot of time, because that's very important.
Yeah. And you want to, when I think of budgeting, and the reason why people don't do it, I don't, it drives me nuts. I don't really budget. I try, when you think about budgeting, what I try to do, and frankly, with all things financial, is just to keep it simple. Don't try to overdo it and overwork it. Divide your expenses up into maybe 2 or 3 buckets. You've got your essential spending, the things you absolutely need to live, right? Then you have your important spending. Your important spending is things that, you could survive without, but they're important to you, so it's not like a vacation or eating out. That's more discretionary spending buckets. So you can really simplify it down and say, here's, the absolute most important things I need. This is the essential spending, and then everything else is discretionary. Or you can kind of break it up into 3 buckets and put an important line item in there. And if you do that, then most importantly, the first thing is what you can cut out if you absolutely have to. So you know what you need, and then you know what you can cut out. And then the second aspect of it is also knowing, is my discretionary spending making up too much of my budget, and should I bring that down in order to be able to save more?
So let me ask you a very important question. Where does Netflix fall on that? Is that a essential spending or discretionary spending?
That's a good question.
That changed a lot in 2020.
Yeah, 2020, that changed a lot. Netflix might be in that important category. I don't know if it makes its way to the essential, but it's
Disney Plus, if you have kids, is
100% essential.
Is definitely
without
question.
Necessary. Without question.
Yeah, and I think it's a silly quote, but one of the things I remember is it can be difficult to put a budget together, or at least to lay it out in front of you, because sometimes you don't want to see where your money's going, right? But the quote that I heard a while ago was, if you don't want to look at your expenses, you should probably be looking at your expenses. You probably should. Right. So,
exactly.
Things, another thing to throw in there is, you're going to see where, your bad debt is, or where, areas of high interest loans where you're going to want to find a way to pay those off as quickly as possible. Now, things like student loans or mortgages, if they're at a low interest, that's the good kind of debt. But we want to isolate and take care of credit card debt and anything that comes with a high interest rate.
And again, super important, because that's probably what people leaned on. If folks this year didn't have an emergency fund, they had to probably lean on debt, and it's going to be high interest short-term debt that they had to lean on in order to get through.
Yeah, exactly. So once we've put a budget together, we understand what we have to work with. What is the first layer that we need to make sure we're taking care of with our budget? And that's an emergency fund, right? You need to make sure you have, there's a lot of ideas, thoughts around how much that emergency fund really needs to be. We work with clients where it really runs the gamut. Risk plays a big part in deciding that, but a general statement, 3 to 6 months of necessary expenses is kind of a good place to start. And some people that satisfies it, right?
Exactly. And it does. You really hit it on the head when you talk about risk. You want to look at your employment, and again, going back to 2020, we can see what are the real risks out there. If you did lose your job, did you have an emergency fund? You can reflect on how much did you have? Did that see you through that period? And if, and I think this is equally important, did it not only see you through that period, but did it help you gain comfort that you were going to be okay throughout that period? Because when you lose that comfort, and we're in a highly stress, and all hell's breaking loose out there, if you're not comfortable, it can lead to mistakes and poor decisions in other areas of your financial life. So, I think a good rule of thumb is at least, 3 to 6 months, but reflect on, what happened with your employment throughout 2020. Reflect on, what you think could possibly happen in the future, and if you could be affected by something similar to this going forward. And if so, you may want to think about upping that to 6 or 12 months. And again, think about what's also going to make you really comfortable, so that you can just forget about what your other assets are doing.
Right.
Because you definitely don't want to have not saved enough in your emergency fund and then watch your portfolio drop 20, 30, 40% and pull money out because you're worried that you don't have enough. So you want to prepare and plan ahead of time.
And, we'll talk about this more, but the inverse is people who are overly conservative or worried and just build a huge emergency fund. And then we see what the market did in 2020, the rebound and all the growth that they missed out on because they felt like they had to sit on a large amount of cash, right?
Absolutely.
That can hurt you as well. So,
absolutely.
Okay. So once we get past emergency fund, paying down high interest debt, then I think with, disposable income, from there, we direct it towards our retirement accounts, right? Those are accounts that we don't plan on touching for even an emergency situation, unless it's a dire emergency and you have that ability. But essentially, it's money you want to set aside to allow it to grow over the long period of time. to get the returns that will, grow your nest egg to sustain you in retirement. But that's the next step in putting a financial plan together.
Right. And, essentially the way that I look at it is I've really got 3 buckets of savings. I've got my emergency fund, then I have my retirement funds, and then I have my goals-based investment account, or what I call my working capital investment account, right?
And you're talking about like a brokerage account, individual account, joint account. They have different
taxable,
names,
exactly. Individual taxable account. And essentially what we know that we're going to retire at some point in our life, or we're at least going to, slow down working at some point in our life. So we know we have to have a source of money that's going to be there to replace the income that we're walking away from. So the earlier we get started on that, the better. And, because the power of compounding helps us. So if you can, if you go through that budget, you look at your savings and you've got a pretty good size savings, then you should review your retirement accounts and say, what am I deferring? What am I putting away? What are my deferral rates? And if you have capacity to increase your deferral rates, you should do that. One pitfall that we've seen with investors is, throughout 2020, folks that were worried about their income, loss of income, that sort of thing, they stopped making contributions to their 401k plan. And a lot of times that was necessary. If you had a loss of income, you probably, it was a good idea to do something like that. But if you did it because you didn't want to watch the market go down, and you were worried about how far the market had fallen, and you didn't want to continue to contribute, that's one where you want to sit back and kind of reflect and see what happened the remainder of the year, because you should definitely resume your deferrals. And the other thing you should do is think about how to behave next time that comes around, because it's a real missed opportunity to not have bought stocks at much lower prices, especially if you're young.
That's a lesson certainly from 2020 that we were advising, our individual clients, but we also manage a few corporate retirement plans, and we would go and meet with the company and the participants. And that was the overall message is, I know it seems scary with the market down, but again, we're talking about long-term money here. So there is no better time to, if you can, keep your contributions. And again, if you can, maybe even increase them, because you're buying stocks at lower prices. And look what it's done since March 23rd, the bottom essentially. I mean, if people were putting in money that whole time, the returns they got, and that's just the importance of staying disciplined.
Exactly.
Yet another lesson from 2020.
I mean, if you look at the various baskets of stock within the market, you're looking at the big healthy companies coming out of March have returned somewhere in the market, somewhere in the range of 50%. If you look at riskier stocks, they're in between 60, 70, 80% coming out of the March decline. So that is real money and real opportunity. And if you take yourself back to March, it was hard.
People didn't want to hear that message, but they had to
do that. But that's the message that we deliver, and that's why that's what we help our clients make sure that they do, is make those prudent decisions at the right time.
Yeah, absolutely. And then talk to us about then how you think about your goals-based retirement account, or investment account.
Right. So that is, the excess again. So I start with the emergency fund, I go to the retirement account, and then the excess money that I have, I put that into an investment account, and that's longer term money. But I use it in the course of my life in order to help me satisfy certain expenses that maybe my cash flow wouldn't do. So that's thinking about things like children's educational accounts. So you'd have a goals-based investment account for that. You're going to put money away in a 529 plan, and that's to pay for your kids' education. You might have an investment account that's geared towards saving for the down payment on a home, because you have the goal to own a home. You might have, big travel plans that you want to take. So that's how I look at the goals-based side of the investment account. That's really my working capital account. It's my partner in life. It's where I take the money that I've worked hard for. I put it in that account in excess of my retirement and other accounts. And then that is what I invest, and it grows alongside of me over time, and it supplants income when I want to purchase something, maybe a new car or something like that.
Well, the other benefit it provides is, getting back to the emergency fund, is you don't have to oversave in your emergency fund if you also have that goals-based account, right? Yeah. Unlike a retirement account where you get penalized for taking money out before you reach retirement age, that goals-based account, that individual taxable brokerage account, goes by many names, can be there for you anytime, right?
Exactly.
You can pull money out. So
exactly.
it can compensate or complement an emergency fund, so you don't have to stockpile a bunch of cash, which, by the way, loses to inflation each and every year. So you can allow it to grow. And if another 2020, another coronavirus, another something comes along that shocks us and we have to dip into our emergency fund, that's a component of it where it's available to you.
Exactly. And that's, I mean, that you really hit the nail on the head when you talked about cash, because I just don't like holding cash. Cash is something that, eats while you sleep, if you will. It's a, inflation will, over time eat it up. And right now interest rates are very, very low. So it's not to say that you don't have some cash for your emergency fund. You need it. And that's just an opportunity cost that we have to take. But anything over and above that, I'm putting to work. And I want to be working for me.
Yeah, exactly. All right. Well, what do you think you learned most about coming through 2020 as an investor? It's a different perspective than just surviving 2020. There was opportunities, but I think when I meet with clients, and especially new clients, right? What I love about 2020 is the new clients we brought on, and it was a very good year for Equius Partners. We brought aboard a lot of clients this year, which was great. We got to advise them and guide them through the tumultuous 2020 that it was. But what I say to them at the end of the year is, what a benefit to have, come in at this time. You are very early already a battle-hardened investor. Right? You learned a lot of lessons in a concise amount of time. In the course of 1 year, the highs of the early part of the year, going through one of the fastest drops in market history, and then coming out with one of the quickest recoveries at the same time. There's a lot to dissect there. There's a lot to learn. The most important from my mind, the biggest lesson, which I hope our clients appreciate, is the importance of having a right plan at the beginning and sticking to it no matter what is happening in the market. The right plan will weather any storm and will get you through to your long-term goals. And for me, I think that really resonated with them in particular, but I think all of our clients really understand that. Yeah.
I mean, I totally agree with that, because the benefit of a plan is you have built some sort of expectations within yourself already, right? One of the things that we spend a tremendous amount of time with our clients on is reviewing and understanding market history, going through past declines and their recoveries, and showing people how markets react and how they behave in times of distress, and how they behave in, coming out of times of distress when more certainty is entering the market. So it's having a plan means that you've done some of that work up front, and you've done some of that education up front for yourself, so that when it comes, it doesn't hit you, like a freight train.
Right.
And that's when something like that hits you like a freight train, it's going to cause panic. And when you get panicked as an investor, you make bad decisions. So it's really important to have a plan going into it, and making sure that you have reviewed how markets work and really understand your asset allocation. How much risk are you taking? What volatility should you expect? The ups and downs of the market. So you're spot on. I mean, that's the biggest thing, is you really need a plan, so you don't get, what was it, Mike Tyson, that said everybody's got a plan until they get punched in the mouth. Right. But that's the point, right? Is you've got to have that plan up front, so that when you get punched in the mouth, that you know how you can bring yourself out of it and make sure that you make the right decisions.
Yeah, and that's a great point. The market has, if you review history and if you understand the history of markets, this sort of thing happens. The causes can seem different, right? Whether it's an oil embargo or a war or whatever it is.
Spanish flu,
right? We haven't seen this exact cause, but we've seen its effects before. Yeah. So, that should be part of your plan. And why, another quote that I love is, the only way you hurt yourself on a roller coaster is when you get out of your seat too early. And the same can be said about the stock market, right? Yeah. Is if you have the plan and you understand market history, this is nothing but a roller coaster ride that you expect, the downs and the ups. You're only going to hurt yourself if in March you got out of your seat and sold, with your portfolio down 30-40% and you missed then the ride up. Yeah. So that's definitely a strong message. Yeah. Well, let's talk about then, the flip side of that coin, when the market does recover and we've seen this incredible run since, the end of March, it can be really easy for our clients to expect that. I mean, I know I brought on a new client and got them invested on March 23rd, had no idea what was going to happen the next day and anything that followed, but literally had them invested at the bottom. And since then, it's been a salacious, outrageous, run for them, which good for them. They believed in what we had to say. They believed in the philosophy. They believed in the strategy, and they bought into it, even though the market was doing what it was doing, and they've been rewarded. So if anything, I want them rewarded, for buying in. But on the flip side, what I also have to counsel is this is not, should not be our expectations every day going forward.
Absolutely.
And we can apply that in many ways. What's happened in the market, before 2019, the 10 years before the run that we've been on. But we can apply it now in 2021 and moving forward, our expectations. So we don't chase these lofty returns that we've seen recently. Right.
Well, it's a great lead into, I think, another big mistake that we're seeing people make and have seen them make in 2020. I mean, unfortunately, I know far too many investors who did sell out in March. And we've now been introduced, we're having conversations, trying to get them back on track. But the other pitfall is, to your point, when you have returns that are really outside of the range. I mean, and again, not outside of the range of normal coming out of a recovery like that, or out of a decline like that. That's fairly normal, if you look back at past declines, the recovery coming out, it's fast and it's really vigorous generally. But you have to counsel them not to think that and set their expectations as this is what it's going to be like, forever and going forward. Yeah. And the other thing that you have to, I've talked to a lot of investors about is chasing, returns and chasing hot stocks. And right now that is a huge issue because we have some really big, well-known companies, some big names who have had really outsized returns in the past 4 or 5 years. The FANG stocks, right? Facebook, Apple, Netflix, Google, Alphabet. Yeah. And I mean, we're talking 30+% returns in some cases per year,
right?
Over the last several years. And it's hard not to want to chase those. And it's really hard not to think that those stocks are going to continue that upward trend. But, again, as history shows, it's very unlikely.
Yeah. Well, when we talk about our projections, now in 2021 moving forward, we'll kind of talk about, what investors should expect and what they should be wary of. And that's certainly a big one. But I think if anything, to kind of wrap a bow on looking back on 2020, no one saw this coming clearly, and no one could have seen it coming. But I think it highlights the importance of aligning yourself. If you're not an advisor yourself, or you just don't have this totally locked up, you've been through 2000.com crash, 2008, and now coronavirus in 2020, and you conducted yourself accordingly and in a good manner, which is, I'm going to bucket 99% of the people didn't haven't gone through those periods.
That takes a lot of grit.
It does. I think it just highlights the importance of why you need to align yourself with an advisor. If anything, advisors should have proved their worth during 2020. Now we know, just being plugged into the industry, talking to a lot of people, there's a lot of advisors out there that should be ashamed with themselves for how they counsel their clients, or really how they acquiesce to their clients' emotions. Emotions is what damages investors' returns almost more than anything else. Yep. And when advisors are panicking, just like their clients are, and having them make changes that they know don't adhere to the long-term plan that they set in motion, that said, you're right, the stocks are plummeting, we need to get out, move to bonds, yada, yada, whatever it may be. There are very few disciplined investors who were saying in the bottom, when in the mud, you need to stick to our plan. Right. We're going to get through this and we're going to be better for it. Yep. Not enough advisors out there. The ones who did, I think, proved their worth in 2020. And that's the importance of having the right advisor, the right counselor, the one who's going to tell you not what you want to hear, what you need to hear.
Exactly. I call it, advice, not facilitation, right? I mean, people pay us to advise them and to give them our best recommendations and provide them value, not to just facilitate their, needs, wants, emotions when it comes to this stuff. We are here to advise them on the best practices and the most prudent way to invest and build and grow and preserve their long-term wealth. And, I don't know how someone, goes on with themselves as an advisor after having basically, just said, hey, you want to get out? Yeah. Okay. No big deal. Or,
right.
Hey, you want to take a little bit of your portfolio and get out? No big deal. Let's do that.
How much easier would that be, right? To
Exactly.
just say, okay, they're feeling happy and good about it, and you get to keep a client or not have a difficult conversation. And I know you've had those conversations this year. We get together as a group and talk about how we advise our clients and counsel our clients. And you've shared a number of stories where you had to have the tough conversation to say, we are going to stick through this and it is going to benefit you. End of March, everything flips, and boy, did they make their money back and then some.
Yeah, and that's to your earlier point. I mean, we have our clients are the best clients in the business, and the reality is that we've had clients for a number of clients for a very, very long time that we've seen go through many ups and downs. I remember the 08-09 market and counseling clients through that. That was a really tough one, and frankly, I don't care how many have been through. Everyone, comes across in some way different and pulls on something different. In this case, a lot of times the coronavirus pandemic pulled on people's health strings, and they were worried that about their mortality came into play, and they were worried about watching the value of their portfolio fluctuate and thinking that their life expectancy had shortened, right? So there's lots of things that can come into play and make it extraordinarily hard to stay in your seat and stay put, and even harder to do what most of us, should be doing at a time like that, and that is rebalancing our portfolio. So if we have a balanced portfolio, if we have a bond component, a less risky component, and a stock component, our stocks drop. That means our bond component has increased. We need to be selling bonds and buying stocks at those lower prices. And if you did that, and that's what we recommended and did with all of our clients, if you did that, then that meant you recovered your portfolio value faster as well, right? So you were able to accumulate a lot of stocks at low prices. That's an even harder thing to do.
Sure.
You can make the decision to stay put, but then to have me look at you and say, and I need you to take some money out of bonds and buy stocks.
Buying these stocks, right?
It's like it's tough.
Well, and it's important to point out, we're not going to dive into it because that's a lengthy conversation we can have, but also the importance, we're not talking about taking money out of bonds and putting it back into individual stocks. That's the importance of having mutual funds, diversified portfolio. So we're not risking the portfolio necessarily going to zero.
Right.
We're spreading it around. But I think, in conclusion, many people think advisors just pick the stocks or pick the investments that go into my portfolio. That's the 25% of what we do. The bulk of what we do is counsel clients through really, really great periods and really, really difficult periods.
Yeah. I mean, we have the benefit of having a very, very robust scientific based approach. So it's to your point, there's lots of investment advisors out there who haven't embraced the science of investing and the empirical research, who are still caught up in the buying and selling of different securities and trying to outperform the market. I mean, it's a really challenging thing sometimes when a lot of investors perceive value around activity, right, rather than progress in their portfolio and progress towards their goals. So, for us, having that empirical basis to our investment strategy is, makes it, very, very easy to really put portfolios together that are tailored to people's objectives, and then spend the bulk of our time with those clients, educating them and coaching them on how to stick with their portfolio and how to make prudent decisions along the way that maximize their overall wealth rather than detract from it.
Sure. Well, let's look forward now. Here we are. It's January 2021. What are the things that someone, listening will, when we're done here, pull out their bank statements, their retirement account statements, and, anything else, where their money may be. How are we advising that they get started in this, hopefully this annual tradition of sitting down and getting a good grip or a snapshot of where they stand and where things need to or should be adjusted? Right. And this, in addition to talking about, what we did before, the budget and the emergency, but.
Well, I would say the good news is this. You really only have to sit down, if you haven't done it before, you really only have to sit down one time and have it be a really, really comprehensive, look through of this. So if you can commit to doing that, you sit down, you look at the expenses that you had for the last year. You do review things within the context of 2020 in some regard of like, did I have enough in my emergency fund? Review your budget. Once you get all of that collected and get it organized, investment accounts, you get that collected and organized and you get a plan put together for a lot of tactical items that you're going to do. Maybe if you did lose a job and you have a 401k, you might be rolling that 401k over to an IRA. And you might have some other IRAs that you want to consolidate. I mean, the biggest thing that you want to make sure that you're doing is that you're getting everything organized, getting your arms around it, and then simplifying it as best you can, right? And then you want to review, as we talked about, what you need to do in your retirement accounts. Again, start with your emergency fund, make sure that's intact, and if it's not and you need to replenish it, make sure you get on a track to do that. Then review your retirement accounts, make sure you're maximizing within your personal limitations, your deferrals. Make sure that you've reviewed your asset allocation in those accounts, make sure that it's still the same. We'll talk a little bit about investments here on that. There's some pitfalls that people are falling into right now when they review their investments. So check your asset allocation, review your behavior through 2021 and say, hey, I got really freaked out by this and I almost pulled the plug, or I did pull the plug. And if that's the case, then you want to make sure that you review your asset allocation and make sure that maybe you don't take as much risk going forward, given that, you bailed out.
Yeah, if that's going to cause you to commit bad behaviors, bad investing behaviors, then you need to adjust your allocation so you're not, tempted to do that. I mean, who would have thought 2020 would have ended up positive, on the year?
I know.
It's incredible. So all those bad behaviors meant that you probably missed out on that.
Right.
And in addition, like, across the board with our investment accounts, but I think people will, hear this better with their 401k, or it'll be more applicable, but make sure that you've rebalanced, right?
Absolutely.
It's quite likely if you haven't touched your account and you haven't set a rebalance schedule, that your bonds and to stock allocation and is off. So you need to make sure you take this opportunity to at least rebalance.
Yeah.
Hopefully.
Right. Exactly. I mean, that's how you control the risk of your portfolio.
Yeah.
Right. So if you didn't rebalance throughout the year, who knows where the asset allocation is now, but you want, again, what we're talking about is planning for the future. You want to get yourself prepared. So if you don't have a target allocation, you should set a target allocation, right? And then, set a plan for rebalancing. There's different ways to rebalance. You can do it on a calendar schedule. You can do it quarterly. A lot of 401k plans do it quarterly. You can do it on a yearly basis, or you can set, bands to allow your account to drift, which is more of a risk-based rebalancing decision. So if one asset class grows to a certain extent, you're going to shave that off and reinvest in what's lagged, just to, again, keep your overall portfolio risk where you want it, so that you don't find yourself, if folks didn't rebalance back in February of this year, and they had, their portfolios had run up and their stocks were up, they probably lost more than they should have in March.
Yep.
And, why have your portfolio decline more than you expect or would like if it's a simple rebalancing decision? And of course, there's tax considerations, and you got to be careful there. But the reality is the asset allocation decision is the most important one.
Yeah, definitely. And as you mentioned, that's kind of a risk equation, right? The right allocation is a balancing or comfort with a type of risk. And, it's always good to reevaluate that at the start of each year, if you will. Or, is this risk still appropriate for me? Is it time for me to take risks off the table? So that's something you need to contemplate. But I think this gives us the opportunity to talk about not just in particular for 2021, but we've seen in a lot of people's portfolios this accumulation of risk that I think people need to be aware of. And if you're looking at auditing where you are, your investments, I think this is something we need to point out, is this risk that a lot of people have been accumulating in their 401k, chasing returns. We touched on that. So let's expand on that. Where we're seeing a lot of red flags that people need to be aware of. And here we are. Equius Partners is located in the Bay Area. We're very close to a lot of tech firms. Tech firms, the FANG stocks, these really big, healthy companies that we all hear about, they're in this category of large growth. So we may use those terms interchangeably. But we're seeing a vast accumulation of large growth companies, holdings in these people's portfolios. Yep. And we've been beating the drum, in so many different ways. And this hopefully is another outlet that we need to let people understand that they may seem like hot companies, big, safe companies, and in some ways that's an accurate description. But from an investor's perspective, those people who continue to amass these large cap companies in their portfolios are potentially accumulating a mass amount of risk, right?
Right. Yeah. I mean, what investors really need to pay attention to is that we're looking at what has happened, right? Yeah. And you got to put in context and historical context that let's look at what has happened, and let's set future expectations of what we think is going to happen going forward. And if you look in the context of history, it's very unlikely that large growth stocks, the big healthy companies, the Googles, the Facebooks, Netflix, those companies are going to be able to match the returns that they have they've amassed in the last 4 or 5 years. Right. They might, but the odds are in history aren't on their side.
The expectations have been raised to such an outrageous level that to exceed even today's expectations would take a type of company that we've never seen before. And a lot of people would argue, well, Amazon's a different company than we've seen before. Right. We could argue the opposite, right?
Absolutely.
Dutch Eats isn't a company, there's a lot of examples of these companies that seem like they're, new and, again, just break the mold.
And the risk that you were talking about within portfolios, and this is what a lot of people aren't aware of, is that these companies' prices have increased so much that their overall size within the U.S. stock market is massive. Their market capitalization is massive. And so if you go look at the total U.S. stock market, the top 10 holdings make up 25% of the overall mutual fund or the index fund. So if you look at that's a total U.S. stock market, 10 stocks, 25%. Yeah. That is,
it's
when
unbalanced.
People buy the total stock market index fund, they think they're getting a very broadly diversified portfolio. Yeah. They got 25% is going into these stocks, and it's these stocks that have had massive run-ups in their prices. Again, might they persist? Maybe.
Yep.
I'm putting my odds on history repeating itself, and of these stocks not being able to continue to achieve the type of returns. And from what's important about that is the reason why we talk to clients about this, and we have clients that have large cap growth stocks in their portfolios, and that is, again, an opportunity to rebalance.
Exactly.
You don't want to concentrate too much risk in your portfolio in any one mutual fund or stock. You want to make sure that you are broadly diversified, and you will get the returns of the large growth stocks and have, but you want to make sure that you're selling them and buying what's underperformed so that you keep that risk and return in balance.
Yeah, and that, to make it clear, we're not saying you have to avoid that area of the market. It has its component like all the other areas.
Exactly.
Don't get so fascinated with these names that we hear in the news.
Yeah.
And make sure that I always say pack a parachute. You've taken the ride, you've enjoyed the performance. At some point the music stops, and being diversified means you pack yourself a parachute, and then you get to perform in the other areas of the market that will inevitably do very well.
Exactly.
So you just want to make sure.
Well, and I mean, the other thing to really educate yourselves on and to think about, there was a great article in the Wall Street Journal that was talking about how there was kind of an IPO frenzy, an initial public offering where companies come out and offer their stock on the stock exchange. There was a big frenzy, and all of a sudden we were seeing, some companies come out. The more recent ones were DoorDash, Snowflake, Airbnb,
Yep.
and the valuations of those companies just skyrocketed to the point. I got the article right here, to the point where you have DoorDash being valued just shy of General Motors Corporation.
Right.
You've got Airbnb, which is worth over $83 billion, which is more than FedEx, company that's been around forever and is a highly profitable company. And you've got Snowflake, which is worth over $100 billion, and that's more than Goldman Sachs. So, again, when you start to look at this and you start to think about these prices and all of these stocks being bid up so high in there, and people paying really high prices for these stocks and their underlying valuations, it's really hard not to, look back and think about the late 90s and the tech boom that happened, and we know what happened after the tech boom. Yeah,
and we work with clients, and we all have friends, and that we talk to who like to dabble and like to participate in that sort of speculation. Hey, maybe this is a unicorn, maybe this is the next so and so company that we've all heard of.
Zoom was the hot one this year.
Yeah, exactly.
And again, there's nothing wrong, to your point, with speculating with a portion of your portfolio. You just want to be very, very disciplined and make sure that you're not letting it overwhelm your portfolio, and you're keeping it in a very small percentage of your overall wealth.
And I think this is a great, lead into wrapping things up. What we're talking about here is, having a plan and having a budget, right? And when we're talking about how we want to invest, it has to be a component of your plan. You have to understand what wealth, you need to set aside and invest prudently. That applies to financial science, the most modern style of investing that takes history into account and odds into account. You need to make sure that that money will reliably grow and be there for you when you need it.
Exactly.
Now, when we're talking about speculating, stock picking, it flies in the face of all the odds, all the statistics, all the research that says 80% of the time that fails. And yes, we're talking about all these hot companies that 80% of them, by the odds will.
Hey, a lot of us still love going to Vegas.
Yeah,
but we know that we're probably just giving the casinos our money.
Yeah. So that's a good context for it is.
So long as you put it in its right place and don't kid yourself. I think one of the biggest risks, especially for young folks, is, to think that they go and they do some speculation and they hit the cover off the ball in a couple of areas, and they develop this view that maybe they've got it figured out, and they go do that with a much larger size portion of their overall wallet. And in reality, that's one of those things that you got to be very careful of. When I go down to Las Vegas, I set a spending limit on myself, right? I know how much money I'm getting out of the bank, and I'm not going over it. There's no going back. Once that's gone, that's it.
Yeah, the fun's over.
Go fund. Exactly. The fun is over.
Yeah. Well, that's great. I think, in conclusion, again, the importance of having a plan, the importance of, budgeting, seeing where you are, and then making sure that you're just taking this time of year, maybe every year, are my investments allocated in a way that suits my goals, my risk tolerance? Am I, again, applying financial science, making sure that I am setting myself up for success, not just by the end of 2021, but in years and years beyond, right?
Exactly.
Because no one knows what 2021 is going to look like. We could go through a second wave. There's going to be something else at some point down the road, and an investment plan should get you through whatever comes our way.
Exactly. And if you think too short term, I know I focused a lot on 2020. I think it's a good learning lesson. But if you think too short term when you put a plan together, you're not going to bring as much reliability and predictability to your overall plan for the long term, because especially when it comes to investments. Short-term returns are very, very noisy. We don't know, they provide us very little information on what's going to happen 5 or 10 years from now. So it's important that you set your plan and you do have a really good long-term outlook.
And we talk about it, what you end up getting by doing that. And up front, the first time you do it, or, sitting down with someone and going through that exercise, it could be, laborious. It could be, a bit of
it's
rock.
We avoid it like the plague.
Totally.
We avoid it.
But the best part is once you get past that, the maintenance that it takes after that is very minimal. And what you end up with is, it's a term we use constantly here at Equius, is just a sense of serenity, financial serenity, family, everything that money touches, which unfortunately is everything these days, and that's okay. But everything that money touches just becomes less stressful. There's a sense of serenity that's provided. And that's ultimately what we want to provide our clients.
Exactly.
So
there's a solution. There is a solution. And if there's tons of things in this world to be stressed about, there's lots of areas of our life where we have anxiety and lots of pressures. And we saw that a lot in 2020. We didn't know what was going to hit us, and we got hit on the economic side of things. We got hit on the health side of things. We were worried about family. We were worried about friends and our community. We were worried about loss. We were worried about our kids. Are they able to go out? All of that stuff. And you can literally, by sitting down and planning, and I would recommend doing it with a fiduciary advisor, getting that plan in place. You can literally take that stressor and anxiety out of your life.
Right. Why not? Great. Well, this has been I think really helpful. This is great, just doing a little recap and having a bright outlook moving forward. So to anyone listening who this resonated with or touched a nerve, there's really no hurdle for getting the help that you need or just getting your questions answered. So definitely take the opportunity to do that, and look forward to joining you yet again at the future podcast.
Absolutely.
All right.
Sounds good. Thanks, Lachlan.